Welcome back, dividend growth and value investors. Today, I'm going to share with you 5 real estate investment trusts with A-rated investment grade credit ratings. As interest rates continue to rise, the need for real estate investment trusts with the safest balance sheets, stability, and yield has never been more important. Hence, in this video, I share a bit of a reflection on the REIT sector, followed by introducing 5 REITs to you, which include some basic metrics. Whether you're a seasoned investor seeking for some inspiration or a newcomer looking to learn a bit more about how I perform basic analysis of real estate investment trust, this movie might be tailored for you. So sit back, have your tea or coffee ready, and let's get started. So if you have been following the stock market on a daily or weekly basis, then it really should come as no surprise that the real estate sector, together with the utility sectors, have been the most beaten down in the sectors in the stock market. 16% so far in the minus, and utilities also almost 70% in the minus. Now, what is interesting here, if you look at this website from Fidelity, it shows actually that during a recession, real estate tend to really do poorly, but when it comes out of a recession, it tends to do a bit better. If you then look at where they think the current phases of the cycles are, which is also quite interesting, not saying that they are right, they believe that the US, for instance, in this case here, is entering at the moment a recession. Really interesting when you look at this cycle here, and also shows that China is actually in the early stages of recovery. While I'm not an economist, I can do such predictions. Actually, I've never seen really a wealthy economist either. Usually those are entrepreneurs, not the ones from the university. But what I can look at is, for instance, the 10-year chart here. If we look here at the 10-year treasury rate from a historical perspective, then what we can see here just in general is that the time we have experienced in the last decade has been below the norm. If you would just draw a line, probably the norm is somewhere around 5%, and that's what we are coming close to. Hence, my gut feel really tells me that this is here to stay. And this is why it's so important to look at the real estate investment trust sector now, because I think we will not see quickly zero interest rates again. So how to deal with this then? Because if this is the new normal, interest rates will increase for all those companies. How to deal with it? Well, maybe I think just really simple. Just take the best real estate investment trust from a balance sheet point of view. You can easily look at all their credit ratings. You don't need to own 100 of these companies. Just take the top 10 with the best credit ratings, do a bit of due diligence, and then look at those that you find attractive to do further deeper analysis. So in my opinion, an A credit rating doesn't happen too often in this sector, so you can easily find them. A conservative dividend payout ratio, I know that they need to pay 90% of earnings, but if you look at funds from operations, which is the real metric we look at real estate investment trusts, you can find companies with a lower than 90% funds from operations. And last but not least, when you do your analysis, just check if they have good tenants. This is also important. You don't want to have tenants that are at the brink of bankruptcy. What I have as an example with Omega Healthcare in my portfolio, definitely not an investment grade credit rating there. So in this video, I will also show you what the basic metrics are here from a payout ratio point of view and such. And then I do a back on the napkin valuation using the dividend discount model, because I really believe that for these slow growing companies, the dividend discount model is probably the best fit looking at the valuation of such a company. So are you ready, guys? Let's start looking at the first one. The first one is Public Storage REIT. Public Storage is a prominent real estate investment trust that specializes in owning, operating, and managing self-storage facilities. They own and manage real estate properties, mainly self-storage facilities, and they generate income by leasing those units to individuals and businesses. It's actually one of the largest self-storage real estate investment trusts in the world. They were founded in 1972 and they are headquartered in California. They actually own and operate thousands of self-storage facilities across the United States, and also, for instance, in Europe. So they have storage facilities in the United Kingdom, Netherlands, Belgium, Germany, and France. I know many of you come from these countries, so probably if you're driving on the highway, you might see them from time to time. Having said that, they've also been in the news lately because they just announced an agreement to acquire Simply Self Storage from BREIT for $2.2 billion. If you don't know what BREIT is the Blackstone Real Estate Investment Income Trust, and they've been selling a lot of their assets lately. Actually, you will hear about them again soon at the next stock that I will be talking about. Now, what is interesting about this release statement was from 24 July, and on the same day, Moody's already rated their unsecured notes worthy at an A2 credit rating. So in the list of 5 stocks that I'm showing today, Public Storage has the highest credit rating, A2. I haven't found a real estate investment trust with a higher credit rating than them. Now, if we also look at briefly at the latest numbers, because this is really interesting here, they had $4.28 per diluted share from core FFO, an increase of 7.3% relative to the same period last year. So for me, it shows that this company is really, really nicely growing. I have not found anything in my quick check that worries me here. So this looks generally good on a high level overview. And let's have a look at some of the more numbers. So credit rating of A2, a yield of 4.3, which is not too bad in this environment still. They haven't cut their dividends for 28 years, but there's a catch here. They have only been growing their dividend over the last year because they had many years of flat dividends over the last 5 years. So that is something to take into account. But if you average it out over 5 years, they have been growing their dividend by 8.5% compounded annually. Now, if you look at the price to FFO, 16.5, I find it a bit much for a sector that is in distress. I would expect it a little bit lower, but they come at a payout ratio of 74%, so it still means they have ample room to grow the dividend. Also, from a funds from operation divided by the interest they need to pay, it's almost at 20. So this shows you that they have a really, really strong balance sheet. Now, what is this company worth paying for? If you take the dividend discount model, so you take the dividend at a 10% discount rate and you expect this company to grow 5% over the next few years, this company would be worth $240. While it's trading at the moment at $276. If you believe that this company can actually grow quicker with 6 or 7%, then this company might be undervalued at this moment in time. Okay, so let's then go to the next company, and this company should not come as a surprise. This Realty Income, and it mainly focuses on owning and operating a diverse portfolio of retail and commercial properties. The company is known for its monthly dividend payments, and that's why they call themselves also the monthly dividend company. I don't think it really needs a further introduction, but if you're interested, then also check out one of my most recent videos via the link in the description below. But as you can see here, they are really having tenants in really conservative industries like convenience stores, grocery stores, dollar stores. Those are not going anywhere. If a recession will be coming, then dollar stores will actually do probably better because people will be looking at cheaper alternatives than the premium grade shopping that they might do when their wallets are flushing full with money. But there has been some recent news here because the B right from Blackstone is really selling a lot, because they announced actually before the weekend that they signed a definitive agreement to invest approximately almost $1 billion to acquire preferred equity interests of the Bellagio in Las Vegas. So, are they now going full into competition with Vici? I don't know. I would love to hear more a little bit from the CEO about this. But it's really interesting that also Realty Income is acquiring some of the real estate assets, let's say, or at least a joint investment with Blackstone Real Estate. It just shows how bad Blackstone is in a situation right now, I think, because otherwise they wouldn't dispose so easily from these kinds of assets. So because it doesn't need any further introduction, I just mentioned you can also refer to the video I made earlier really quickly about Realty Income, a A3 credit rate. Again, one of the highest in the industry, a yield of 5.4%, a little bit more attractive, I would say, than Public Storage from that point of view. 29 years of uninterrupted growth. They actually hike their dividends several times a year typically. They have a dividend CAGR for 5 years of 3%, which could be a bit more in my opinion. A price to funds from operations of almost 14 and a payout ratio of 75%. Here you see a big difference because their FFO divided by interest multiple is 4.5. So this is a bit on the lower end from all the companies that I'm showing today. So it also shows that they have a little bit more exposure to debt than the other companies. But on the other end, you saw just the tenants that they are there. Those are triple lease agreements that they have. So I think we're really good here with Realty Income. Now, if you use here the dividend discount model, I use a 10% discount rate again, and only a 4% dividend growth. I think this company might even just grow 3% in the next few years, but just showing you that at a 4% dividend growth, this company would be worth $51. Now, the third company that I'm going to share with you now might be actually a little bit lesser known by you, because this is Camden Properties Trust. This is a real estate investment trust that specializes in the ownership, development, acquisition, and management of multifamily apartment communities. This company is focused on providing high-quality living spaces and amenities to its residents. Camden operates in multiple metropolitan areas across the United States, including the key markets like Texas, Florida, California, and more. When I hear this and when I study this, it really feels like these are retirement homes where the wealthy Americans goes. I haven't studied it well enough to judge that, but that's really how it feels like. As you can see here, they're quite well diversified over the South in the United States. But what I like most when I was looking a bit through their latest earnings reports is this, because this shows why they have such a strong credit rating. Because look here, total consolidated debt to asset value, 28%, far below the covenants. Why are these covenants important? Because this tells you whether you need to pay more interest, whether you need to sell off properties. This is what the banks will be looking at. Here, consolidated income available for debt service to total annual service charges, 637%, while they are expected to do minimum 150%. So for me, this tells me that this is a company with a very safe balance sheet and actually should help us sleep well at night. Because also if you look at the family apartments and such that they have build and rent to their tenants, come on, it's not like people will suddenly flood out of those altogether. So for me, this is really a sound, stable business model with a very strong balance sheet behind it. So how do their basic numbers look like then? So if we go to Camden, again, also a credit rating of A3, yield of 3.73%. I'm not surprised that it's a bit on the lower end because you must pay a premium for this one, I'm afraid. Years no cut 14, but also here again, no straight line of dividend growth, but not cut it for 14 years. Still at a 5-year compounded annual growth rate of 5.3%, a price to FFO of 15, which is probably good enough for this kind of balance sheet, a payout ratio of only 60%. So they really have ample room to grow their dividends going further, and an FFO to interest of 5.9. Now, if I look at it and I do my valuation at a 5.3% dividend growth equal to their last 5 years and a 10% discount rate, I believe it's worth $85 compared to the $107 that it's trading now. So in my opinion, this price still has to come a little bit down to me before it becomes interesting, and probably it will be then yielding around 4.5%. If it hits that number, I might really consider investing in this one, because this is for me one of the most and best sleep well at night stocks that I've seen in the real estate investment sector. Okay, so let's go to the next one, and it's actually quite similar to this one, because here I'm talking about Avalon Bay Communities Trust. This looks actually a little bit similar to Camden Properties, and it is one of the largest publicly traded multifamily real estate investment trusts in the United States. They were founded in 1978, they are headquartered in Virginia, and they focus on creating and managing apartment communities that offer high-quality living spaces and amenities. So, sounds pretty much the same, right? Also here again, they have at the similar locations. I think Americans love to live at the coast in these kinds of places, because it's all around the coast and also all around the south of America. Now, a little bit more still about Avalon Bay. They have a market cap of around $32 billion. They have around 89,000 apartment homes, 295 communities, and an annualized total shareholder return of about 11.4% since IPO. Really not too bad. It's something that I typically sign up for, because this is even better than the annual S&P 500 historical return. So if we look at Avalon Bay, then here in my overview again, also a credit rating of A3, a yield of 3.64%. They have, again, 25 years of dividends without a cut. But again, they kept it flat during COVID. That's why you see only 1 year of real growth behind it. I find their 5-year dividend annual growth a little bit disappointing at 2.3%, especially when you can see that the payout ratio is only 64%. I still find it a little bit on the expensive side from a multiple point of view with 17, and the FFO divided by interest 6.4, nothing to worry about. If I run it through my fair value calculation, and I'm taking really the low growth into account, even though the payout ratio is 64%, then this company is still having just a fair value, in my opinion, of $101. And look, the price is at $181. So this is really, really a big gap. And that's why this company is not attractive to me now. But hey, if you're fine with this yield and such a strong balance sheet, then why not, right? Okay, so this was stock number 4 with an excellent balance sheet. Now let's go to the 5th one, which is in my opinion the best one, especially from a valuation point of view. And this is Simon Properties Group. So, Simon is a real estate investment trust engaged in the ownership of premier shopping, dining, entertainment, and mixed-use destination. It has a direct or indirect interest in approximately 400 retail properties across 24 countries. They generate over $100 billion. 215 of those are based in the United States, and others are, for instance, in Japan, Canada, Mexico, Austria, Germany, Spain, and the Netherlands. What is actually really interesting is that the company also owns a 22.4% stake in Klépierre. This is a French real estate company with a 7.4% dividend yield. David Simon, as you can see, CEO of Simon Property Group, is their chairman of the supervisory board. So with this, you don't only own a stake in those retail properties directly owned by Simon Property Group, but also in Klépierre. Now, what is interesting here, if we look at Simon Property Group's share price here, it is good to note that in 2020, during COVID, it fell off a cliff. It went instantly from $140 to about all the way $50. That was a 60 to 70% decline. It has recovered quite significantly there until the end of 2021 at the top of $166, and now it's trading at $112 again due to the increase of interest rates. Now, why I'm sharing the share price chart? Because I have not done it for the others, right? Because typically I prefer to keep the share price chart away from it to avoid price anchoring. It doesn't really matter usually where it was trading 2 to 3 years ago if the company is overvalued or undervalued now based on the price. I believe that if it's undervalued already today with a margin of safety, if you need this, then you should just buy it and don't worry. But I'm still sharing this because I know that there are quite some investors that think like, okay, $112, it goes back to $80 maybe, so I'll get it at $80 or at $60. But guys, how I look at this, right? I believe that after the Spanish flu, COVID was the first time in 100 years we have seen such a global pandemic again. Now, the question you need to ask yourself, do you expect this to happen again? If you expect this to happen again in the next 5 years, okay, you might be right. But if you expect this to happen, such a global pandemic, like once in 100 years, once in 50 years, then looking at the reference of 2020 makes really no sense, because COVID impacted everyone being in lockdown. Lockdown prevented foot traffic, but you need to think about which other black swan event can really prevent a total abundance of foot traffic, because we're talking here about premium shops also like Prada and such, which are owned by L'Oreal. Yeah, of course they have also Macy's and such, which is maybe not the strongest business in itself, but this is what you need to consider. So for me, anchoring towards a price of the bottom of 2020 personally makes no sense, unless you believe that another pandemic will hit in the next few years. Yeah, then maybe it does. So I really want to reiterate this because I think it's important that we need to look at this from an interest rate point of view, not so much from we might get a COVID situation again. But hey, that's my opinion. You might have a different opinion on that. Let me also know in the comments of this video because I'm quite curious to that. Okay, so moving away from the price chart, if you then look at how the company behaved during that time, well, it shouldn't be a surprise that the company also dropped in its funds from operations because some of these stores were just at the brink of bankruptcy at that time. So funds from operations still dropped from 12 to $9. But what's really interesting here is that they had to cut the dividend because of that as well, because of the covenants that they have with the banks. And I mentioned already before what covenants means there. But they dropped it till around $5.85 in 2021, if you look at that annualized. But what it also tells us, if you take the $8.30, they could have covered it if they wanted to. It would have been a bit of a bigger chunk out of the cash flow, but they could have covered it, and that's important. And what we can also see now again, that it's been nicely recovering since then. And if you're still skeptical about that, then just look at their latest quarterly earnings. Their funds from operations were $1 billion, $2.88 per diluted share, which is comparable to the FFO they made last year. And what you need to know is like the interest rates are higher now. Yes, so what I'm trying to say is like while interest rates and the interest expense increased for Simon Property Group, they were able to make the same funds from operations, which in my opinion is quite a good deal. Also, they have a higher occupancy rate now with almost 95%. What's more, the weighted average interest rate on their loans that they have issued in the first 6 months have been around 6%. So that's the reality of the environment right now. So if we then look a little bit more at their debt, because they have a debt ladder as well, you can see here what their long-term debt arrangements are, and they showed here in the table. So they have still 1.3 billion to reissue probably, and also 800 million in interest payments. And then over the next 2 years, they will have a big chunk of debt coming available of 6 billion. So you all need to take this into account because they will have to reissue this. What you can also see here is like in general that the effective weighted average interest is around 3 to 4% on their financing. So yeah, their interest expense will still increase. But this is for me where the beauty comes with owning a stock like Simon Property Group, because it has a credit rating of A3, which means just it has an investment grade top-notch credit rating. Again, I want to reiterate, there are not so many real estate investment trusts with such a credit rating. But what we can see here is the stock market is quite bearish on it because they put the company at a yield of 6.9% almost at a price to funds from operations of 9%. I think this is a bit overreacting, specifically with the FFO payout ratio of 64%. Now, if we expect that the interest expense will go up significantly, I believe that the FFO to interest multiple might drop maybe to a 4 or something like that. And that's still okay, guys. That's still okay. It also means that they might have a small dip in their funds from operations next year even. But that's still okay when we look at the dividend. Now, I showed you already that the dividend was cut 3 years ago. That's why it has a meager dividend growth and also a 5-year CAGR of minus 1%. The question here, therefore, is the dividend safe? I honestly believe the dividend is safe. I don't think we will see such a drop in FFO as what they had to suffer during 2020. I don't expect a pandemic to happen anytime soon. And if it hits, and if I would own SPG, okay, so be it. It would be a small fraction then of my portfolio. But if you look at it from a valuation point of view and you believe that another COVID won't happen, another pandemic, and you believe that a lot of this is already priced in from the interest expenses that they will need to pay in the upcoming years, then I believe this company is actually attractively valued right now. Because if you believe that the company can grow with a 4% annualized dividend over the next few years at a 10% discount rate, this company should be trading at about $127 versus the $110 it's doing today. So out of all these 5, you get it already. Simon Property Group is for me the most attractive one here when it comes to the price. It's maybe not the highest in the balance sheet. That's Public Storage. Also a very interesting one for you to consider if you're into these kinds of stocks. Personally, I will do some more homework on Simon Property Group. I would love also to know more about this from people that own it already in the comment section below. But yeah, that's it, guys, from my side. I've shown you here 5 top A-rated real estate investment trusts. I hope also that this gives you, like, let's call it a filter out of a screener for you to do some more homework if you want to take the opportunity of by investing in some real estate investment trusts but are concerned in generally about their balance sheets. I truly believe that these A-rated credit-worthy companies are good starting points for that. Guys, if you enjoyed this video, hit the like button. If you haven't subscribed yet, please do it. Hit the notification bell. And yeah, see you next time again.